What if I told you that the stock market is like a giant, never-ending game of Monopoly, but with real money and real consequences? Sounds intriguing, right? Welcome to Finance 123, where we make finance simple, fun, and easy to understand. Whether you're a complete beginner or someone who's always been curious about how the stock market works, this video is for you. We're going to break down everything you need to know in a way that's engaging, conversational, and totally relatable. So if you've ever thought about investing but didn't know where to start, stick around. And don't forget to hit that subscribe button and ring the bell so you never miss out on our future videos. Let's dive in. What is the stock market? The stock market is a global marketplace where shares of companies are bought and sold, allowing individuals and institutions to own a piece of those businesses. Unlike a traditional market where physical goods are traded, the stock market deals in financial assets, specifically stocks, which represent fractional ownership in a company. When you buy a share, you own a small portion of that company, and the value of your investment rises or falls based on the company's performance and market conditions. Companies list their shares on stock exchanges such as the New York Stock Exchange, NYSE, or NASDAQ through an initial public offering, IPO. Once listed, these shares are traded among investors. The price of a stock fluctuates based on factors like the company's financial health, industry trends, economic data, and investor sentiment. If a company performs well, its stock price may increase, boosting the value of your investment. Conversely, poor performance or negative news can cause the stock price to drop, potentially leading to losses. The stock market is a complex ecosystem involving various participants, including individual investors, institutional investors, like mutual funds and pension funds, traders, brokers, and market makers. These players ensure liquidity and efficiency, enabling smooth transactions. Market makers, for example, ensure there are always buyers and sellers, while brokers facilitate trades. Investing in the stock market can be rewarding but carries risks. Some investors focus on long-term growth, holding shares for years, while others engage in short-term trading to capitalize on price movements. Regardless of the strategy, the stock market offers opportunities to grow wealth over time, making it a vital component of the global economy. Why do companies sell shares? Companies sell shares to raise capital, which is essential for growth, innovation, and maintaining operations. When a company goes public through an initial public offering, IPO, it offers shares to the public for the first time, allowing investors to buy a piece of the business. This influx of funds can be used for various purposes, such as expanding operations, developing new products, entering new markets, or paying off debt. Essentially, selling shares provides companies with the financial resources they need to achieve their goals without taking on additional loans. For investors, buying shares is an opportunity to own a stake in a company and potentially benefit from its success. If the company performs well, the value of its shares may increase, allowing investors to sell them at a profit or earn dividends. However, investing in stocks also carries risks. If the company struggles or fails, the value of its shares can decline, leading to potential losses. Despite the risks, the stock market remains a popular way for companies to raise funds and for investors to grow their wealth over time. How does the stock market work? The stock market operates like a massive auction house where buyers and sellers trade shares of companies. The price of each share is determined by supply and demand. If more people want to buy a stock, its price rises, and if more want to sell, the price falls. This constant back and forth between buyers and sellers causes stock prices to fluctuate throughout the trading day. The stock market isn't a single location, but a network of exchanges, such as the New York Stock Exchange, NYSE, and NASDAQ, where these transactions take place. These exchanges act as platforms, ensuring fair and orderly trading. Companies list their shares on these exchanges, and investors, ranging from individuals to large institutions, buy and sell them. Brokers and market makers facilitate these trades, ensuring liquidity and efficiency. The stock market is a dynamic, fast-paced environment where prices react to news, earnings reports, economic data, and investor sentiment. For investors, it offers opportunities to grow wealth, But it also carries risks, as prices can be unpredictable. Understanding how it works is key to navigating this financial ecosystem. Key players in the stock market. Who's pulling the strings behind the scenes of the stock market? It's not just individual investors like you and me. There are several key players who influence how the market operates. First, there are the companies that issue shares. Then there are institutional investors, like mutual funds and pension funds, who buy and sell large quantities of shares. Brokers act as middlemen, helping individual investors buy and sell stocks. And finally, there are regulators, like the Securities and Exchange Commission, SEC, who ensure that the market operates fairly and transparently. But here's the thing. Even though these players have a lot of influence, the stock market is still driven by the collective actions of millions of individual investors. That means you and I have a role to play too. Types of stocks. Not all stocks are created equal. Some are like roller coasters, thrilling but risky. Others are more like a steady train ride, safe but not as exciting. The two main types of stocks are common stocks and preferred stocks. Common stocks give you voting rights in the company and the potential for higher returns, but they also come with more risk. Preferred stocks, on the other hand, usually don't come with voting rights, but they offer more stable dividends. Then there are different categories of stocks, like growth stocks, value stocks, and dividend stocks. Growth stocks are companies that are expected to grow quickly, while value stocks are companies that are undervalued by the market. Dividend stocks are companies that pay regular dividends to their shareholders. Each type has its own characteristics, and understanding them can help you make better investment decisions. How to start investing in stocks. Ready to take the plunge and start investing? The first step is to open a brokerage account. This is where you'll buy and sell stocks. There are many online brokers to choose from, so do your research and pick one that fits your needs. Once your account is set up, you'll need to decide which stocks to buy. This is where research comes in. Look at the company's financial health, its growth potential, and its industry. Don't just follow the crowd. Make informed decisions based on your own analysis. And remember, it's okay to start small. You don't need a lot of money to begin investing in the stock market. In fact, many brokers now allow you to buy fractional shares, which means you can invest in expensive stocks without breaking the bank. Common mistakes beginners make. Let's face it, we all make mistakes, especially when we're just starting out. But when it comes to investing, some mistakes can cost you a lot of money. One common mistake is trying to time the market. No one can predict exactly when the market will go up or down, so trying to time it can lead to losses. Another mistake is not diversifying your portfolio. Putting all your money into one stock is risky, because if that stock performs poorly, you could lose a lot of money. Instead, spread your investments across different stocks and industries to reduce risk. Lastly, don't let emotions drive your decisions. Fear and greed can lead to poor investment choices, so stay calm and stick to your plan. The importance of patience and long-term thinking. Here's a secret. The most successful investors aren't the ones who try to get rich quick. They're the ones who stay patient and think long-term. The stock market can be volatile, with prices going up and down every day. But historically, the market has always trended upward over the long term. That means if you stay invested for the long haul, you're more likely to see positive returns. So instead of worrying about daily price fluctuations, focus on the overall growth of your investments over time. Remember, investing is a marathon, not a sprint. Stay disciplined, keep learning, and don't let short-term setbacks discourage you. And there you have it, a complete beginner's guide to understanding the stock market. If you found this video helpful, don't forget to give it a thumbs up and share it with anyone who might benefit from it. And of course, subscribe to Finance 123 for more easy-to-understand finance tutorials. We're here to help you navigate the world of finance, one step at a time. Thanks for watching, and we'll see you in the next video.